In this set of slides, we're going to continue to focus on character. Character means it is a capital asset generating a capital gain or loss, an ordinary asset generating ordinary gains or losses, or what we're going to introduce, a 1231 asset, which works to preserve capital gains if you have the right set of facts, but allow you to have ordinary losses. So by now, you should have a feel for the fact that a short-term capital gain is going to be taxed differently than a long-term capital gain, and that a capital loss. So we're going to talk about a few odds and ends: bad debts, worthless securities, 1244 stock, and then we'll get into the nitty-gritty of the chapter, the 1231 assets and depreciation recapture. And then we will also look at that 25% capital gains rate that applies to net 1231 or long-term capital gains from the sales of real estate. So the bad debt deduction, if it is a business bad debt deduction, you'll get an ordinary loss for either full or partial worthlessness. So you open up the paper, you hear about a bankruptcy, and the best guess is you're going to get 10% on the dollar back. If it is a business bad debt, you could take 90% as a bad debt loss now, and then wait to see whether or not you actually got the other 10%. Business bad debts arise in connection with a trade or business, and these are the kinds of things that would give you a business bad debt. And note, I forgot to mention, the most important thing here is it's an ordinary loss versus a capital loss, because if we got to have a loss, we'd much prefer to have an ordinary loss than a capital loss. Non-business bad debts would be money you have loaned that don't meet the requirements of the last slide. A casual loan to a friend to get his business started, a legitimate loan with the right amount of interest being charged and all the good things from way back in the semester. Or you put some money into a bank and the bank goes belly up. These would be non-business because you're not in the trade or business of making loans, nor is the loan directly related to a trade or business. It must be totally worthless to take a deduction, and the deduction will be treated as a short-term capital loss in the year of total worthlessness, and that is short-term whether the loan was outstanding for 6 months or 6 years. Back in chapter 12 or 10, I mentioned that you generally need a sale, exchange, or other disposition in order to recognize a loss from a capital asset. When a security becomes worthless, there is a separate rule for that. If it is a capital asset, if it becomes worthless, it's deemed to be worthless on the last day of the taxable year in which the security becomes worthless. So that's a lot of words, but you pick up the newspaper this time and you find that the company you own stock in has become worthless, is in bankruptcy court, and they do not expect any shareholders to receive anything. If this was on January 1st of 2013 or July 13th or December 31, you would be deemed to have a disposition on December 31, and then you'd figure out whether it was long-term or short-term based on how long you would hold it. So it's very unlikely to have a worthless security generate a short-term capital loss. You would have to be unlucky enough to buy the stock in January or February, or even March or April, and have it become worthless shortly thereafter. And so most worthless securities will generate a long-term. Staying with the theme of capital losses are bad, ordinary losses are at least a little better. The purpose of 1244 stock and the 1231 property we're going to talk about shortly is the government is helping investors defray some risk of an investment. So here they're going to guarantee you some ordinary loss treatment if your capital asset, the stock you own in a company, is sold at a loss. It's not 100% guaranteed ordinary, but partially. So a 1244 stock is issued by a small business, and those are the ones that are most likely to go belly up, right? So the government wants to encourage investment in small businesses but also wants to give taxpayers a break if it does go bad. There'll be some ordinary loss treatment instead of it all being a capital loss. So a small business is one that has issued not more than $1 million worth of stock, regardless of money or other property, at the time that the stock is issued. And these stock certificates will be actually stamped that they're 1244 stock, so that, but they would only be 1244 stock in the hands of the original purchaser. So if you sold it, it would then become normal stock to the next person. So when you have a loss, individual taxpayers only, not corporations, are allowed an ordinary loss deduction, and that is for a sale, exchange, or worthlessness of the 1244 stock. Now remember, we're normally generating capital losses when we dispose of stock. In this particular case, we'll have a partial ordinary loss treatment, and the ordinary amount is determined by filing status. Individuals, the first $50,000 of loss in any taxable year. So I might have $1 million worth of loss. If I simply stretched out the selling of the property, I could get ordinary income treatment for all of it. But if I sold the entire million, realized the $1 million loss in a current year, only $50,000 of it will be ordinary. A couple, married filing joint, have a limit of $100,000, and that exists whether or not they own the stock jointly or it's owned by just one of the spouses. Any remaining losses are treated as capital losses. The next couple of slides provide an overview of the rest of the chapter. So if you get confused by what I'm saying here, hopefully it'll get clear before we're done. So we're going to be characterizing gains and losses. Once again, remember the type of property controls the gain or loss. And in this particular case, we're going to be focusing on section 1231 property. I'll define it at length in a little while, but it's that third bullet back on the slide in chapter 10 that defined whether or not something was a capital asset. Remember, depreciable property and land used in a trade or business or rental is never a capital asset. If you own that property a year or less, it's ordinary income property. If you own it for more than a year, it becomes this 1231 property that's going to be the focus of the bulk of what's left here. So a 1231 property will generate a 1231 gain or loss after these things called recaptures. And when I use the term recapture, I'm not recognizing more income. What I am doing is recharacterizing what was potentially going to become a long-term capital gain. I'm recharacterizing it as ordinary income so that it's always going to be taxed at the highest marginal tax rate. So land that is used in a trade or business or rental that's been used more than a year, all the gain or loss will be what we're calling this 1231 gain or loss. And then buildings are what we call a subset of 1231, which is section 1250. And we have a recapture rule here. When you have a building that you sell at a gain, you will have ordinary income to the extent of this thing I'm going to define as the excess rule. But we'll define it when we get there, right? And then the gain on buildings are section 1250 property, reduced by the recapture, and any losses from buildings, because these recapture rules you're going to see only apply to gains, that will be called section 1231 gain. So I know it gets a little confusing. A building used in a trade or business or rental more than a year is 1231 property. We call it 1250 because that determines what the recapture is. Once we determine whether there is any recapture or not, our building will actually generate 1231 gains and losses. So the amount realized and recognized is not always going to be 1231 gain, even though it's a 1231 asset. But we're going to do this a bunch in the rest of the chapter. It should be making much more sense after a few more slides. So continuing this, 1245 property is equipment. So it's equipment used in a trade or business or rental for more than a year. So it's 1231 property. We identify it as 1245 for the recapture rule. And the 1245 recapture, ordinary income to the extent of gain that is less than or equal to accumulated depreciation. And so gains reduced by the 1245 recapture and any losses will be called 1231 gains. Now we're going to start our more in-depth coverage of Section 1231 assets. First of all, we will define again what 1231 property is. We will talk about what happens if you have a net 1231 loss. And the net here is just like a net capital gain, right? You put all your 1231 gains and losses together for the year. If you net negative, we have one set of rules. If you net positive, we have another set of rules. So 1231 property, depreciable or real property used in a trade or business. And remember, the code section itself just says trade or business, but it has been widely accepted since the very beginning that rental properties are included here. Rental properties are not trades or businesses. So to have them included here is something that's worth noting, right? And you must hold them for more than 1 year. And then there are some other really weird things that are 1231 property, but we're just not going to go there. Our heads are full. And then remember that if it's not a capital asset, and depreciable property and land are not capital assets, if we've owned them a year or less, they are considered ordinary assets, and they will generate ordinary gains and losses. Okay, first of all, remember, even though it's a 1231 asset, all of the gain may not be 1231 because we have those depreciation recaptures that we will be covering when we finish the netting process. So once you've determined how much 1231 gain or loss each of your 1231 assets are generating, then you add them all up and you net them. If you have a net 1231 loss, you get an ordinary loss. Remember, the goal here is for the government to encourage investment by trying to offset some of the risk. A capital loss is a terrible thing to try to use. And so what they promised you here is that if you'll buy business assets, those that tend to create jobs and gross national product, not stock, not artwork, but equipment, buildings, things that tend to generate jobs, or rental properties, which also help generate jobs, right? Gives people a place to live or work. If things go south, we will let you have ordinary loss treatment if your net 1231 losses for the year are, if your net 1231 gains and losses for the year are negative. So an individual 1231 loss does not guarantee you ordinary loss treatment, because it's only once you've netted them all that if you net negative, you can say that loss is an ordinary loss. And that's an absolute rule. This is the one place where there are no extra caveats. If you have a net 1231 loss, the character of that loss is ordinary, end of story. So what happens if you net positive, if you have a net 1231 gain for the year? Well, prior to 1986, which was the last time they reworked the Internal Revenue Code, you would have just had a capital gain. But when they reworked the tax code, they needed to generate revenue, because remember, they lowered those marginal tax rates all the way down to 28% for all income. And so they needed to find different sources of income. So it is possible for someone to plan by having a net 1231 loss in 1 year, and that loss will be ordinary. And then by just waiting until the next tax year to sell properties which would generate 1231 gains, they would land up with capital gains. And so they added this rule that when you have a net 1231 gain, before you can get the brass ring, which is to characterize it as a long-term capital gain. Because remember, if you're going to have gains, the best kind are long-term capital gains because they have the best tax rates. You have to look back or recapture. So remember, recapture means just to recharacterize what could have been a capital gain as ordinary income. So the way they determined how to figure out how much is ordinary income is they created a look-back rule. When we get to depreciation recaptures, you're going to see that when you sell a car, you know how much depreciation you've taken with that particular car. And so the recaptures for depreciable property are tied to individual properties. But in this particular case, the loss could have been generated by land you sold 2 years ago, and the gain being generated by a building that you sold today. And so there's no real way to tie them by type of property. And so they simply decided to tie by a period of time. And so that period of time that you look back is 5 years. All right, so you look at prior years, net 1231 ordinary losses, and they create an IOU a recharacterization of ordinary income. So the look back period they determined was 5 tax years. And when you look back or carry back, you always go to the oldest year first. All right. So the net 1231 gain is recharacterized as ordinary income to the extent of the net 1231 losses in the look back period that have not already been recaptured. And this is a lot simpler than all those words are. When we come to the next example, you will see that it's actually pretty straightforward as long as you have a way to be organized. And you remember that when you look back, you go back to the oldest year first. And any gain in over the ordinary income recapture is that finally that long-term capital gain that we're struggling so hard to get. Continuing our topic or discussion of 1231, we'll start out with an example of the recapture of net 1231 losses. Remember, this happens when you have a net 1231 gain in a given year. And then I'll briefly talk about gains and losses from casualties or theft. We will cover that in more detail in the last set of slides where we're actually going to cover casualty and theft losses. And then we will look through the full 1231 netting procedure, all the way from recognizing an individual property to netting to determine whether you have a gain or loss. So here we have an exercise, and this is very similar to what you'll see in the blackboard and what you'll see on your group and mini tests. So you start out with a net 1231 gain in a given year. You want to take that gain to your Schedule D. You want to treat it as a long-term capital gain. But before you can do that, you have to look back to the last 5 tax years to see if you have any unrecaptured net 1231 losses. And I have to give you that information, right? So I will tell you whether or not there have been any net 1231 losses in the last 5 years. To the extent there are, there will be ordinary income. And anything that is left of the net 1231 gain will be a long-term capital gain. So on the next slide, we have the 1231 gains and losses for the 5-year look-back period. And then we're just going to go through and take each year at a time, go into the oldest year, talk about what have happened in that year, and then prepare ourselves for the next year. So here is Jan's history of 1231 gains and losses prior to 2013. And we will never have any that are outside the 5-year look back because life gets really complicated, right? Because if I had 2007 here, what happened in 2007 would affect 2008. And so what we'll set it up is they've never had a 1231 gain or loss prior to our 5-year period. So in the real world, what you would have is just a record of the final answer that we're going to come up with, because you would know going into the next tax year what your unrecaptured 1231 gains and losses were. But in this case, we want to work through each of the years in order to talk about what's happening and reinforce the learning process. So remember, when I turn the slide, we go to the oldest year first. So the first thing we're going to do is talk about what happened in 2008. So remember, when we look back, you're going to go to the oldest year first. The oldest year 5 years back. So 2013, 5 years back is 2008. And you have to work your way through all 5 years to figure out what is still outstanding in your tax year of interest. So in 2008, we had a net 1231 gain. We have no 1231 history prior to this. So when we look back, there's nothing back there. And so the entire $5,000 is going to be a long-term capital gain. And that's the money shot, right? That means now we have a potential of getting a preferential tax rate. And I should remind you that this netting process has to be done whether one is an individual or a corporation. So a corporation, the only thing they have to gain here is if they can get a net 1231 gain characterized as long-term capital gain, it may be able to offset some otherwise unusable long-term capital loss or short-term capital loss. But the corporations aren't going to get any special tax rates. So in 2009, life is not so good. You had a net 1231 loss. And net 1231 losses are always ordinary, end of story. And so you have an ordinary loss, but it creates an IOU. For the next 5 years, 2010 through, you have the potential of having ordinary income recharacterization of your net 1231 gains. So the 1700 is an ordinary loss. And now in 2010, life is better. I have a net 1231 gain. I would love to take all of it to my Schedule D. Instead, I have to look back, and it turns out that I have $17,000 of unrecaptured 1231 losses caused by that net 1231 loss that generated ordinary losses last year. So that means that the first $17,000 of my net 1231 gain is ordinary, and the rest of it is a long-term capital gain. But the good news is I have wiped out my IOU. Right? If I never have a loss again, my net 1231 gains will always be long-term. But that's not what happened in 2011. I had another loss. The loss is always ordinary, end of story. And it creates the IOU of the $15,000 for then going forward. And so for the next 5 years, I have the potential of having to recapture my net 1231 gains as ordinary income until I have paid back the whole $15,000. So life is getting better. 2012, I have another net 1231 gain, but I do have $15,000 of unrecaptured 1231 losses at the start of the year. So the entire $9,000 is going to be ordinary income, but it will reduce my IOU from $15,000 to $6,000. And then we're finally ready to answer the question. So in 2013, I have my net 1231 gain of $22,650. My unrecaptured losses are that $6,000 that I have not paid back from 2011. And so my $22,650 gets divided up, $6,000 ordinary, and $16,650 as the long-term capital gain. So this is fairly straightforward. It seems cumbersome, but as long as you remember to go to the oldest year first and simply figure out if you have ordinary losses, you create an IOU. If you have ordinary income, you've paid back some of the IOU. You should be just fine. So net gain or loss. There are 3 steps to this netting process. The casualty gains and losses that we're just going to briefly allude to, and then the netting of the gains and losses to come to the net capital gain or loss, 1231 gain or loss. And then if you net positive, the last step here is the look back rule to to determine if any of the net 1231 gain is ordinary income.